The market didn't move in one direction in 2025. It split. Large cap stocks held their ground, mid caps delivered uneven returns, small caps slipped, leaving many portfolios bruised. And that divergence is now driving the biggest investing question for 2026. Do you stay safe with large companies? Or look for opportunity where prices have corrected sharply? So what are analysts advising as investors reset for the year ahead? Let's break it down in this episode of Market Special, but first, a quick break. Twenty 2025 was anything but even for Indian equities. The Nifty 50, dominated by large companies, rose about 10%. The Nifty Mid Cap 100 gained a modest 5%, but the Nifty Small Cap Index fell nearly 7%, its worst performance since 2022. The gap widened further. The NSE 500 trailed the Nifty 50 by its widest margin since 2019, according to Bloomberg. And several well-known names bore the brunt. Stocks like Tejas Networks, Praj Industries, and Ola Electric fell as much as 62% from their peaks. Analysts point to three key factors. First, earnings divergence. Large companies delivered steadier and more predictable results. Smaller firms didn't. Second, risk aversion. With global uncertainty and uneven domestic growth, investors preferred safety over growth bets. Third, liquidity concentration. Institutional money stayed with large liquid stocks, starving mid and small caps of support. The result? Deep corrections with several small cap names down more than 50% from their highs. Most experts agree on one thing: don't swing to extremes. For balanced investors, allocations of 55 to 65% in large caps with limited exposure to mid and small caps are being advised. For aggressive investors with 5 to 7 year horizon, exposure to small stocks can be higher, but still selective, not broad-based. The common thread across views: discipline over dispersion, selectivity over blind exposure. There is cautious optimism, but no blanket endorsement. Now, some analysts say valuations in parts of the small cap space have corrected meaningfully. Median stock prices are well off their peaks, creating pockets of opportunity. But correction alone doesn't make a segment cheap. Growth expectations are still built into many stocks. And without a clear earnings recovery, valuations by themselves won't drive sustained gains. External triggers like clarity on US trade and tariff policies could lift sentiment. But without earnings support, rallies may struggle to hold. If you're investing for stability, large caps remain the anchor. If you're chasing higher growth, mid and small caps can play a role, but only with patience, research, and discipline. Because 2026 is shaping up to be a year of measured optimism, not easy money. That's it for this episode of Market Special. Stay tuned for more market deep dives that help you invest with clarity.